Hi there, welcome to Kneppy Invest and welcome to another portfolio and technical update video. Fairly busy video today because we were looking at the performance of my three portfolios. And to be honest with you, I was pleasantly surprised by the performance of one portfolio and unpleasantly surprised by the performance of another. Now, I have a long-term portfolio, a medium-term portfolio, and a short-term portfolio. The long-term is using fundamental analysis, finding the quality of a company and wanting to own those high quality companies for as long as possible. The medium term portfolio is trying to find those companies that could become high quality in the future. So we're talking about smaller companies. My short term portfolio is a technical analysis or uses a technical analysis strategy. So we can compare fundamental analysis versus technical analysis. And I don't want to spoil anything, but right now, technical analysis is absolutely destroying fundamental analysis. So maybe I should become a technical analysis or a chartist based off the performance of these three portfolios since the start of this particular financial year. And they'll become evident in a second. Now to the performance of actually, before I talk about the performance of my portfolios, the second thing I'm going to do in today's video is a technical update. So we'll be looking at the XGO, Nasdaq, about 5 commodities, and then finishing with 25 individual company charts that are listed on the ASX. But now onto the performance of my three portfolios. So I was pleasantly surprised by one of them. And the reason I was pleasantly surprised was because that particular portfolio was up during the week when the overall market was down. It was a nasty week. The first 4 days, the ASX or the XGO was down, XAO was down, and then it looked like we're going to see the fifth day, the Friday, down as well. In fact, at one point, after 10 minutes of trading, the XGO was down 1.5%. And then we saw a beautiful rally during the rest of the day. And in fact, the XGO finished up by 0.5% on the day. I did a video on that that's released on the Friday. So have a look out for that video if you haven't watched it. And I think one of the reasons why the XGO or the Australian markets rallied during the day, and I haven't really dug deeply into this, haven't looked at any news flow or anything like that, but one of the possible reasons was because the American futures were up during the day. So the investors, the day traders, or whatever you want to call them, expected that the American markets were going to be up, and then they expected the Australian market to follow the American market on the Monday. And do you know what happened on American markets overnight? Well, the Nasdaq at one point was up over 1%. So those who were bidding up or buying into the Australian markets looked like they were going to be right. But just the complete opposite to what happened to the Australian markets, what happened on the American markets was totally different. Instead of buying in the second half of the day, we saw a lot of selling. So instead of being up by over 1%, the Nasdaq was only up 0.5%. And I think the Dow Jones and the S&P 500 were actually down on the day. Now onto the performance of their three portfolios. So long-term portfolio, I was unpleasantly surprised by the performance of this. My medium-term portfolio, pleasantly surprised because that was up. And the short-term portfolio, my technical analysis, well, still going strong. That's all I can say about that. Now, so my long-term portfolio is just full of high-quality companies. Now, not all of these I would classify as high quality, but definitely high quality. So the best performing company is PWR Holdings. Then we have Nick Scali, Domino's Pizza, Breville, Baylor, REA Group, Pro Medicus, JB Hi-Fi, Aristocrat, blah, blah, blah. Worst performing company is Resmed. I'm going to talk about Resmed later in the video because we will be looking at the chart for that company. It is looking really interesting. And some of the other worst performing companies include, we have Shopify, which is down about 18% capital gains, Taiwan Semiconductor Manufacturing, and also PayPal. The best performing American company, in fact, is Alphabet. Also, Apple is down 10.23%, not including currency. The other thing to mention here is because I do have quite a few holdings in international exchanges, I do get a currency gain or loss. And because Australian dollar has gone down, my currency gain is at 1.15%. So overall, this long-term portfolio is slightly outperforming the market or the benchmark. And the main reason behind that is because of the currency gain and some nice dividends. If you look at the capital gain, down significantly more than the benchmark. And that's disappointing. So you should expect that high quality companies are performing right now. It's not true at this point in time. Now to the performance of my medium-term portfolio. And I was pleasantly surprised by the performance of this. It was up during the week. So at the end of last week, it was up 5.17%. Now it's up 5.44%. Now I'll talk about Duratec later in the video when we look at the chart. But you'll notice if we list the performance of these companies by return, that these companies are, particularly the better performing companies, are performing far better than the best performing companies in my long-term portfolio. The reason behind that is many companies in this particular portfolio are smaller companies, and they can go on significant runs. So we're talking about EML Payments, who did beat expectations when they released their full-year results. Doug Technology, Audinate, Ansell, Aussie Broadband, EZZ Life Science, Playside Studios, Johns Lyng Group, Chrysos Corp, Visan, Laserbond, all performing spectacularly well since the start of the financial year. Some of these companies may belong already in the high quality long-term portfolio, in particular Aussie Broadband, Johns Lyng Group, and I fully expect Audinate to be a high quality company, or for me to categorize that company as a high quality company in the next 5 years. Whether some of these other companies can be classified as high quality in the next 5 years remains to be seen. I'm fairly dubious about some of them, but quite excited about a few other. So a really good performance for the medium-term portfolio. Some of these companies are performing very well at this point in time. Now onto the performance of my short-term portfolio, completely using technical analysis. I have made many mistakes, technical trading for companies within this portfolio. Significant errors, significant mistakes that I'm learning. But still, even though I've made significant mistakes, and I think I wouldn't be making these mistakes if I had more experience charting or using technical analysis. But overall, the short-term portfolio is up 9.4% compared to the benchmark, only down. I was going to say, which was only up, but it's actually down 0.46%. I didn't make any acquisitions in the week, and my most recent acquisition was Australian Ethical Funds, and that has been performing quite well. So, in fact, we'll have a look at that particular company's chart when we get into the charting section of this particular video. So, at this point in time, performing really well, the short-term portfolio. So, possibly, I should become a chartist. I should just use technical analysis based off the short-term portfolio's performance versus the long-term portfolio performance. So that's completely opposite to what experts say. You should not be using technical analysis at all. They say you should just be buying companies for the long term and holding them forever. No reason I'm doing this is to see if that does work. Maybe. And the reason I'm saying that is I don't think the one strategy is fits all sort of strategy. I don't think everyone can use that buy a company forever, high quality company forever, and be successful doing that. There's other strategies out there, and I think every single investor has to find a strategy that they're suited to. And that's what I'm doing now, because I actually do like technical analysis. I do like looking at charts. In fact, I probably prefer it over the long-term portfolio. I also really like looking for small cap companies, those sort of companies that are in my medium-term portfolio. So I'm just testing what I'd like to do in the future. And if my short-term portfolio continues to really outperform my long-term portfolio, maybe I just have to change my strategies and ignore buying high-quality companies. Maybe just trade them, maybe. Anyway, that's the whole point of me doing this exercise, to see what suits my own personality. Now onto charts. And we'll start with the XJO. So I've already sort of talked about the XJO in a standalone video I released on Friday, the 22nd of September, because of what happened on that particular day. But I'm going to talk about the longer term view, the longer term picture looking at the XJO. And to be fair with you, nothing's happening at all. Sideways, going sideways, consolidating, a consolidation pattern that has been going on for about almost 1 year. Definitely from about December last year. So we're talking about the 9 months, no, 10 months, 10 months. Are we in September? Yeah, September. So we're talking about 9 months or so where the XJO has just been going sideways. The most important thing here is, and one of the reasons why also we might have seen a bounce is that the XTO just fell below 7,000 for a very brief period of time. And since the XTO has been consolidating, every single time we've seen the XTO go below 7,000, it's rallied and hasn't stayed below 7,000 for very long. And in fact, on Friday, the 22nd of September, it only stayed below 7,000 for about 2 hours. Yes, only 2 hours. If we look at the longer term picture, so the weekly chart, the XTO has just been trading in a range, a beautiful range for 15 years. And right now, it's sort of in the middle of the range. It could go higher, it could go lower from here. It's really interesting. I was listening to Aussie Business Call with Ben Clark and someone else, and Ben Clark is really bullish, really bullish. Not sure why, because there's so much uncertainty right now when it comes to will countries move into recession or not. If they do move in recession, how bad it's going to be. There are signs that we are heading towards that direction, but this time is a little bit different, particularly when it comes to employment. But if we start to see unemployment ramp up, I think we are headed for some troubled times in the next few years. And there is a potential, if we are headed for troubled times, that the SGO, the Nasdaq will drop like a rock. And again, I've said this a few times, just because we see interest rates starting to drop doesn't mean the markets will rally, because during recessions or just after recessions, when the interest rates start to drop, we also see markets drop. So that's actually a positive correlation between the two. Most people think there's a negative correlation between interest rates and the market, but during bad times or recessions, there's actually positive correlation. You'll see interest rates and the market drop at the same time. We saw that during the GFC. We also saw that during the tech bubble burst back in 2000. Interest rates and the markets dropped at the same time. I don't think many people understand that. Nasdaq had been looking bullish. It's starting to look more, and I wouldn't say absolutely bearish, but we are starting to see it struggle. The main reason behind that, the last high we saw was lower than the previous low or previous high. And if the Nasdaq falls below 14,600, that means we're going to have another lower low. So a lower high is already there. And if we get a lower low, that could be the start of a new downtrend in the Nasdaq. I haven't included the Dow Jones here, but the Dow Jones is looking more bearish as well. So possibly the good times have come over or are over for the Nasdaq. And I have a few companies that are listed on the Nasdaq. Now to some commodities, starting with iron ore. Wasn't sure if I had included iron ore, but iron ore looks actually interesting, down 1.2% in the past 24 hours, but it's holding firm, which is surprising because of what's happening with China. But it's holding nicely, not quite as bullish as uranium. I have to look at the weekly chart for this one. Uranium, beautiful. I was bullish, very bullish uranium back, say, late 2020, early 2021. Bought few uranium companies. Then I sold profits. I had Boss Energy, and then I sold for a small profit, and that was a silly mistake. So it's good to make mistakes because you learn. And there was no reason for me to sell out of Boss Energy because uranium chart looks absolutely spectacular, and it's going exponential, which is a little bit of a troubling sign. You can see going exponential 2 times in the past 2 years, back in September 2021, and then again in February 2022. And then we did see uranium prices fall, which is understandable. So I wouldn't be surprised to see uranium prices fall from $69 a pound, I'm pretty sure it is, down to say 58, 56, which will be very healthy if we do see a little bit of correction. Just like we saw the last 2 times, we saw the prices exponentially rise. Oil looks really good. Just look at the daily chart. So this is a beautiful looking chart for oil. We saw this little pullback, we'll call that, pullback into the moving average zone, the short-term moving average zone, and then it started to rise again. So that's a really healthy pullback, nice rise, and this is a definite start of a new uptrend. How high will it go? Who knows? Who knows? But I don't own any. Actually, I own one oil company, and that's just based off valuation. And maybe I should be thinking about owning some more oil companies right now. Lithium. What I'm doing with lithium is, because you also have to look at the weekly chart for this, I'm looking for the first non-down week. So we've had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 down weeks in a row. Eventually, we're going to see it bounce, just like we saw back in May, June. Nice little bounce. But it's fallen a lot, 85 all the way down to 28.78. So looking for a bounce there. Surprising that a lot of lithium companies' share prices held firm. Alchem's share price has dropped a fair bit. Pilbara maybe. Well, actually, I like, because a lot of lithium companies' share prices have dropped a lot, apart from Liontown, but that was under a takeover bid. Now to gold. Who's bullish? Gold. I don't know anything about whether gold's going to go up or down in the future, so I just focus on the chart. Without doubt, gold has been trading in a range for the last 3 years. The top of the range is around about 2,060. The bottom of the range is around 1,620. And we have seen it really struggle to get above the top of the range. And we can see that if we look at the daily chart. But the last time it tried to get above the top of the range was in May of this year, and it failed. And as soon as it hit the top of the range, it pulled back. At this point in time, looks like gold is just going sideways. There's no trend at all. If there was a trend, you might be saying it's down, but even the downward trend is fairly weak right now. So around about 1920 and going sideways. I did have a look at few gold company charts, and most of them are in downtrends. I'm pretty sure I did include one in here. Red 5. And I think the reason I included red 5, I think it's red 5, is because most of the gold companies' charts look fairly negative, apart from red 5, apart from Ramilius, if I remember correctly, and maybe one or two others. Most of gold companies' charts look fairly weak right now. So that's all I've got for the commodities. Without doubt, US oil is second best. Uranium is the best looking chart. But I would expect a little bit of pullback in uranium prices just because the price has gone, not have gone, that's extremely bad grammar, has gone parabolic or exponential over the past few weeks. Now on to individual companies' charts. We've got 25 to go through here. Hopefully I can do this fairly quick. I'm recording this on Saturday evening, 5:38 right now. I want to eat at 6, so I've got 22 minutes to get through 25 charts. I don't think I can do it. I can ramble on a bit. So the first one I'll look at is Australian Ethical Investment. So the first 1, 2, 4 charts we're looking at are companies I own. Australian Ethical Investment is not, have not taken a position in this company because I'm a believer of ethical investing, just because of the chart. Look at the chart. And share price keeps on going higher. So you can see share price starting to move up. It's moving into an uptrend. We've seen a couple of pullbacks, and the next high has been higher than previous high. So this is the definition of an uptrend. Last time the share price of Australian Ethical was this high was way back in start of 2023. And in fact, if we go to that high, the price has tried to get above it. So this means the last time share price was this high was actually back in November last year. So we're almost at a 1-year high for Australian Ethical Investment. And even though I took a position in this company just because of the chart, one of the other reasons I'm bullish about this fund is because they got the name ethical, and the sort of group they're aiming for, say, millennials, Gen X, that's not Gen X, I'm Gen X, Gen Z, they don't care about what companies this fund invests in. They just see the name ethical and just put their money into it. It's ethical. And I am highly dubious that most companies, I should say that the right way. I'm highly skeptical that most of the companies that this company or this fund invests in are ethical, because ethical is open to interpretation. What I define as ethical, you may not define as ethical, and so on and so forth. I think I mentioned this before. I did listen to an ethical fund person speak, and I found them very unethical in what they were doing. They were, in a way, blackmailing companies to get who they wanted on the boards, which I think is highly unethical. Highly unethical. Australian Broadband. Australian Aussie Broadband. And the main reason I added, so I own this company for the long term. It's in my medium-term portfolio. I want to own this company for the long term. I think eventually it will be considered a high-quality company, although there is arguments against that. And then I took a trading position because of this chart, a beautiful looking chart. So remember, it was a bad week on the ASX. Now look at what happened to Aussie Broadband share price in the last 4 or 5 trading days. It was up every single day in the week. That's really bullish. The second really bullish So I not only look at the share price movement, look at these candlesticks, I also look at the volume. Look at the massive increase in volume in the last week. So that means fund managers are getting interested around this company, which is interesting because I thought fund managers would be highly interested in this company because of the growth and potential growth in the future. But fund managers are now starting to get more interested in Aussie Broadband, and that's why the share price is racing higher. Last time the share price was this high at $4.16 was back in May 2022. So we're talking about almost 18-month high in Aussie Broadband share price. And did I do a video on the financial year 23 results? Yeah, I did. And the results were spectacular in my opinion. Now to Duratec. So someone did ask me, did I sell Duratec? I did. I might do a standalone video on this. So I sold some shares in Duratec, then I realized it was a mistake, and then I bought them back almost the next day. So within about 2 or 3 trading hours, I bought them back. The main reason I sold was because the share price fell below $1.12, and I thought that was bearish. But I also have to remind myself to be patient. Just because the share price fell below that level doesn't mean you necessarily have to sell out at that point in time. You can just wait to see if there's a bounce. So if we look at the 1 hourly chart, you can definitely see the share price fell below $1.12 in the first hour of trading on Monday, stayed below that level for the rest of the day, and then it bounced. In fact, it bounced in the last hour of trading on the Monday. So I sold on that Monday, and then I saw it bounce on the last hour, and then I bought back in the first hour or so the next day. Share price a little bit higher than when I sold. But that's the most important thing, is admit when you've made a mistake and act on that. And if I didn't realize I made a mistake, I probably would be regretting that. Now, share price has rallied. Now, just because the share price has rallied doesn't mean we're safe now. Doesn't mean this was the bottom of the share price. If the share price falls again below $1.12, that would be concerning. This is the weakest Duratec chart has been looking like for just about a year or so. And the main reason it looks weak now is because some of the directors sold some shares, not all the shares, just some shares. And investors hate when directors sell or managers sell some shares, even though it's not a lot. There's no research. Research has been done on this. There's no correlation between directors or managers selling and the future performance of the company. There is some sort of correlation between the short-term share price movement of the company and directors selling. But when you look at the financial performance of a company, directors selling means absolutely nothing. Directors buying or management buying, actually, there is a bit of a signal there, but there's no signal when it comes to directors or management selling, particularly if it's not a lot of shares. And directors and owners of this company, maybe not owners, managers of this company still own a lot of shares in the company. They just want to buy a yacht, or maybe they want to buy another property, or maybe they want to diversify their holdings, something like that. Anyway, CSL. So I own a long-term position in this company, and I'm also willing to trade CSL. And this is starting to look interesting, down to $252. Why does it look interesting? Let's have a look at the weekly chart for CSL. Now, you can see this sloping black line. This is the long-term uptrend. So the long-term uptrend suggests the share price should be around $190. But the share price of this company has been well above the long-term uptrend since 2016, well above it. And we've seen the share price of this company just consolidate since 2020. So it's been consolidating for about 3 years, which is understandable because if you look at the long-term trend and the share price, when it bounced off it back in 2016, it accelerated. Share price went from about $90 to a high of $340 in about 3 years. And I think that share price appreciation was just too much. It was just too rapid. And that's why we have seen the share price of this company just consolidate. Now, the reason 250 looks interesting is because whenever the share price of this company gets between 240 and 250, we see buying. We saw it during the COVID-19 financial panic. We saw it back in March 2021 and again in February 2022. And it looks like May we'll see it again. So if the share price falls below 250, I'm going to have to think about taking a trading position in this company. And then if the share price falls below 240, I'll just sell that position because that would be a sort of a bearish signal if it breaks below $240. So on Monday, if the share price does fall below $250, I will take a position in this company, a trading position, which I do on occasion. Now, those are the companies I own. The rest of the companies in this particular list, so 21 companies, I don't own. The first company is a company I have on my watch list as a company I would like to buy because the chart looks absolutely spectacular until the last 2 days. This is a beautiful looking chart. We're talking about Avita Group, ticker code MAD. Some might say you're mad if you don't own this company based off this chart. But then something interesting happened the last 2 trading days of the week. Share price on Thursday fell 10.05%, no announcements. And then the next day, share price fell another 7.8%. Now, I did actually go to Hot Copper just to see if anyone had anything. Maybe there was, maybe someone knew something, loose lips or something like that. And someone did mention there was very low volume on the Thursday. And then I went, oh, yeah, there was low volume. But then on the Friday, when the share price was sold off again, volume significantly increased. Now, this could be just a buy the dip opportunity for Avita Group. Share price has now fallen about 17% in 2 trading days. In fact, it's fallen from $8 to $6.27. PE ratio is still 37.3%. So you wouldn't call this company cheap, but really impressive growth in revenue over the past 5 years and nice growth in profit as well. Low profit margin, 6.33%. Probably the only negative thing about this company, but beautiful looking chart and possible buy the dip opportunity, just like we saw back in March 2023. If the share price gets to say 580 and we don't see any more selling, volume really dries off and the share price starts to creep higher, that's when I might actually take a position, a trading position in this company. Now to 2 companies that were absolutely beloved over the last few years, Brainchip and Weebit Nano. These charts look absolutely horrific. And this is a warning to all those who are caught up in story stocks. The reason they're called story stocks is because there's no financial numbers. It's all about words. So be very wary if a company has no financials, no revenue, no profits. It's all about the story. It's all about words. And when it's all about words, it's all about the marketing. And the best way to look at it is you want a company to be able to, or the share price to actually grow through time with zero marketing. My one complaint about Rectify Technologies, a company I did a video on, is the lack of marketing, but the share price of that company has risen nicely over the past 6 or 7 years on the back of growth in revenue and on the back of the company being profitable. I was still complaining about the lack of marketing because I think that company's valuation could be significantly higher if they had more marketing. So that's the way I look at story stocks or any company really. I prefer to buy companies in regards to numbers. Do they have numbers instead of do they have, or do they only exist because of words, if that makes sense? Now, a perfect example of this is Brainchip. And we look at the chart for Brainchip, so much hype in this company. And the hype really began just after COVID-19 financial panic. It began in, say, May of 2020. There was one hype period in September 2020 when the share price just rallied stupidly higher. And then we saw the other really second hype period in January 2022 when the share price went from about 60 cents to a high of just over $2.30. You can see the share price going exponential. When you see the share price go exponential like that, no matter the volume, it's going to sell off no matter what, particularly if it's a story stock. So I was trading Brainchip at this point in time. I sold at about $2. I didn't completely sell out. And then I completely sold out back in October 2022, so about a year ago. And the share price just keeps on dropping. This is a well-defined downtrend. No reason to even think about buying this company right now because, again, it's a story stock. Revenue in the past year for this company was $2 million. Loss making $28 million. Market cap of this company is still 341.9. This company has to prove themselves. They have to prove that their story can produce numbers, produce revenue, produce profits. A lot of selling in the past week. So in the past week, we saw the share price drop 6.8%, 9.1%, 10%, 11%. So it was worse every single day until Friday when the share price was only down 2.5%. But look at the volume, massive volume coming in during the last 6 trading days. That could be a sign of capitulation. That's probably the only good thing I can say about Brainchip Holdings is possible capitulation. But I would say shareholders are getting a little bit impatient in regards to this company, impatient around the lack of any revenue, that sort of thing, because it's been a while since I think shareholders would have expected some revenue coming in, and more than likely they would have expected some pretty good revenue coming in. At this point in time, Brainchip has not delivered, and that's why the share price is in a really bad downtrend. And Weebit Nano sort of overtook Brainchip in terms of hype. You can see a nice rise in share price from October last year through to March. Share price reached a high of $9 on the 10th of March. Share price now $3.35. And definitely the trend has changed in this from an uptrend to a lot of volatility, massive volatility through most of this year. And the share price fell through a support level just above $4.50, and the share price just keeps on falling. So another instance of a story stock getting beaten. I think just like Brainchip, this company has to prove themselves to the market. And the market cap of this company is still 628 million, which means the market back in March for this company was nearer $2 billion. Maybe not quite $2 billion, maybe $1.5 billion, but still $1.5 to $2 billion for a company with zero revenue, just words, just a story. Loss making by $39 million. Anyway, now it's a Viva Leisure, or leisure, depending on when you come from. I lived in America for 8 years, and I heard the word leisure about 1,000 times. And every single time I heard Americans call it leisure or pronounce it leisure, I just couldn't stop laughing. It just doesn't sound natural, but that's just me. So leisure. I'm pretty sure Viva Leisure owns gyms. I'm not a big fan of that sort of business model, but just because I'm not a fan doesn't mean it's not a buying opportunity. Look at the chart. This is actually looking a pretty good chart, sort of chart I'm looking for, sort of the pattern I'm looking for, pattern recognition. So last time share price was this high at $1.51, was way back in June of 2022. So we're talking about 15-month high in the share price, a market cap $136 million, nice growth in revenue, $141 million in the last year, profitable $3 million. I just don't like the business model of this company, but the market disagrees with me. They like this company right now because the share price is in an uptrend. Now into Betmakers. And the reason I've included Betmakers is because I heard two experts on Ausbie's the Corp say, oh, they've taken a position in Betmakers because it looks cheap. Why? My big question, I just want to ask these two experts, why? When you look at this chart, it looks absolutely horrible and there's no end in sight to the downtrend. Why not just wait? Wait till there's a good sign. Wait till there's a catalyst, a good financial report from the company. Company is now free cash flow and operating cash flow positive, or maybe the share price is going sideways. Maybe wait till that, because the share price is still in a downtrend. Market cap $88 million. Revenue has just now going sideways. Loss of $39 million in the last year. And just look at the chart. It's just, this is why technical analysis is really important, I think, because you can think a company looks cheap, but then just look at the chart and go, well, this is horrible. And even if the share price bounces, there's going to be a lot of resistance because so many shareholders have bought into higher prices. They're just going to sell. They're going to wait for the rally in the share price and just sell. Share price has been a downtrend since November 2021. So we're talking about 2 years ago when the share price was over $1.20. Share price of this company has dropped from $1.20 to 9.4 cents. No reason to think about taking a position in this company. This is just my opinion, by the way. You can completely disagree with me and take a position in Betmakers. Share price could fall another, or could halve from here, more. It could definitely do that. It could go down another 90% from here. It could go down 100% from here. Tuas. I actually don't know how to pronounce this. Tuas, Tuas. This is the old, what's his name? The guy who ran TPG, David Teo. I'm pretty sure he runs this now. I could be completely mistaken. The main reason I like this is just the chart. Nice uptrend since about March. Share price rallied a lot in the first few. Oh, that's right. This company released their financial results, and the market must have liked it because the share price rallied 10.5% and then another 4.5% and then that's pulled back. And the main reason it pulled back is because the previous high was at the same level. So just a technical pullback. Market cap almost $1 billion. I don't think the numbers are quite in. Revenue $94 million, but still loss making in the last financial year. So just the chart for Tuas Limited. If we look at the weekly chart, I just want to see. Yeah, if we go actually look at the weekly chart, there's a lot of resistance at these levels, just around about 220. Go back to, I just want to put in a little line here. You can see share price rallied up to that level in December 2021 and pulled back, and it's done it now 2 times in the past. So if it breaks above say $2.30, so when I put a line, I don't look at that line as a share price resistance level. I look at it as a zone. So between $2.20, it was really between $2.10 and $2.30 is a resistance zone for this company, because that's the highs we have seen in the last few years. And if the share price can get above $2.30, that would be quite bullish for this company. Time is now 5:57. So we've got a few companies now. I'm not going to finish this in 3 minutes. Aeris Resources. This is a company I own and I sold because I was disappointed in something, and the share price keeps on dropping. The reason I'm now interested in following Aeris Resources a little bit more is because of this dashed line, this bottom dashed line, which is around about 17 cents. Share price of Aeris Resources is now 19 cents. So what's the significance of that bottom dashed line? It's the COVID-19 financial panic low. There it is. It reached a low in March. Share price went from 17 cents all the way to a high of $1.70. I don't think it was that low or that high, because there was a capitalization of their shares, or recapitalization, a consolidation, I think is the word. And yeah, so it's just where the share price is now compared to the COVID-19 financial panic. So the sentiment in this company is so bad that people are not willing to buy, less willing to buy this company right now than they were during the COVID-19 financial panic, put it that way. So that's why I'm interested in this company, and I'm more interested in this company just because the interest in this company, the sentiment in this company is just so bad. But just like many other companies, why not just wait till Aeris Resources can show they're turning things around? Because the share price of this company could fall significantly more from here. But maybe 17 cents could be a sneaky buy, just because an historic good support level. Kathmandu, or KMD Brands, as they call themselves now, because they bought Rip Curl. Share price dropped a lot from about May, from $1.04 all the way down to 70 cents. So we're talking about, is that 50%, not quite, 30% drop in share price? 10, 30, yeah, 30% drop in share price. Share price has rallied a little bit in the last week or so. I'm pretty sure this company also released their financial results and actually looked pretty good. I was like, okay, not that bad. And that's why I think we have seen the share price rally and some good volume coming in. So possibly some good value when it comes to KMD Brands. And again, if we look at the weekly chart for KMD Brands, the COVID-19 low was around about 60 cents or so. The absolute low was actually 44 cents, but there was a nice bounce during that week. So I was actually paying more attention because it looked like the share price was moving towards those COVID-19 lows. And I think this company, I wouldn't call it high quality, but I think there is possible value there if the share price of this company falls to those levels. Market cap $545 million, dividend yield 7.2%, price earnings ratio 16.7. Nice growth in revenue, nice profit was flat, that sort of thing. Wesfarmers. Okay, Wesfarmers. So I did mention at the start of this video that I think I mentioned it. There are some big companies I'll be talking about. So CSL, Wesfarmers. I'm pretty sure I've got Coles on here. The main reason I want to look at Wesfarmers is because the share price moved above this nice little resistance level, which is now support. It's been going sideways. So that's good. Not enough selling to drive the share price below that resistance level. So a little bit bullish when it comes to Wesfarmers. My only concern about this company is valuation. In my opinion, this company is completely overvalued. Even with a PE ratio of 25, it's overvalued. But I could be mistaken. And in situations like this, I'll probably refer to the chart. And if the chart looks bullish, even if I think the company is overrated, I'll probably just defer to the chart and take a trading position in that company. But if I think a company is undervalued and the chart looks really good, ooh, that's a different story. SXE, Southern Cross Electrical Engineering, probably an engineering company. Look at this chart. It looks beautiful. Not only that, massive volume coming in the last few trading days. So someone likes this company. Share price has gone from about, or increased from about 68 cents to 85 cents in the last few weeks. And you can see the share price going up and then just a bit of a flag or a pennant, share price going sideways or slightly down. That's very healthy, and then going up again. That's the sort of pattern I am looking for. Weekly chart for Southern Cross. Whoa, look at that. So, look at this. So we draw a high back in 2017, and the share price has gone above those 2017 highs. I don't know anything about this company. I just looked at the chart and went, oh, this looks interesting. Markup 223 million, dividend yield 5.9%, prices earning ratio 10.9%, 11% or 11. Revenue down from last year, profit up. Revenue down, profit up. I would prefer to see revenue up, profit up. But someone likes this company right now and pretty bullish. And we're talking about last time the share price was this high for this company was way back in 2014. So we're almost at a 10-year high for Southern Cross Electrical Engineering. Now onto a company called A4N, Alpha HPA. I think the only reason I wanted to look at this company is because if you look at the weekly chart, let's go back to the weekly chart. Beautiful uptrend. Look at that beautiful uptrend. Beautiful, beautiful uptrend on the weekly chart. But you might notice if you look at the weekly chart, in the last few weeks, the share price has really gone backwards a fair bit. In fact, the share price has fallen from about $1.20 down to 86.5 cents. Possible buy the dip, but this daily chart looks fairly bearish right now. And we have seen, apart from the one spike in volume, we have seen the volume pick up over the past few months. I'm trying to remember what this company does. They have high purity something or other. High purity, it doesn't say what they do. High purity alumina or something like that. Makes the glass for the phones or something. Anyway, markup, actually, look at the markup. It's pretty high, 760 million, no profit, no revenue, so unprofitable. So you could say this is another story stock with just words and no numbers, but I'm pretty sure their factory to produce the high purity whatever is close to starting. I could be wrong, but the chart did look pretty good, and now it's looking a little bit more bearish. Now onto a company I want to own, Objective Corp. I would classify this company as high quality. They had a bad year, but I think it was a one-off. So revenue sideways, profit just up a little bit. The chart looks fairly bearish, and the share price has fallen through a nice little support level at around about $11.90. In the last few trading days, it's fallen below that. It looked like maybe the downtrend was coming to an end, but then the company released their results and the market didn't like it. P ratio of this company is still 53.8, but I think that might be okay for this company. Even though it had a sort of a sluggish year, I think that sluggish year might more than likely will be a one-off. Dividend yield 1.7%. So this is a situation is when it comes to this company, I want to own shares in this company. Possibly, just possibly, I'll nibble, take a small position. And if the share price falls even further downwards from there, I could average down, which I know some people say you should never do that. But this is a high quality company. My only concern is the chart looks pretty negative. So what I could do is just wait for the chart to look a little bit more positive, or wait for the next positive catalyst for the company. If we do get a positive outlook, positive catalyst or something, more than likely the share price has already moved into sort of an uptrend, and there's negative sentiment has gone away. That's what I would think. So possibly I'll just focus on the chart, and if the chart looks like the bottom has been reached, that's when I might take a position in Objective Corp. Fenix, a company I did own, an iron ore company. I sold out of this and then bought Mount Gibson, and I'm thinking maybe I should buy again into Fenix. Share price has fallen a fair bit from when I sold, so I sold at 32 cents. Right there. I'm gonna kind of gloat. I'm going to gloat. Not many times do I time it absolutely perfectly. This was a perfect. I still remember thinking, yeah, I'm just going to take my profits in this, sell at 32 cents. I wasn't sure if what the share price was going to do. I didn't really care about the dividend, and that was one of the fears I had. The dividend was coming up, and I would fully expected the share price to absolutely tank it after the dividend was paid, just like we saw last year. Share price rallied to 37 cents before the dividend, and then it fell from 37 cents down to 20 cents by November. I think the iron ore prices probably helped with that fall as well. Share price now at 22.5 cents. So why am I thinking about buying back into Fenix? If you look at the weekly chart, 20 cents is a really good support level for this company. If I get rid of sort of the moving average ribbons, so you can see that. So since late 2020, share price of this company has remained above 20 cents. And every single time the share price gets to 20 cents, that's a time to buy. Last time it happened was back in October last year. So if I see the share price get to 20 cents, maybe a buy, sneaky buy for Fenix Resources, because the iron ore prices have held up. Now, they decreased their dividend, so the dividend yield is not quite as attractive anymore for this company. Maybe that's why there has been a little bit of sell-off, even though the iron ore prices have held firm. So I have now put Fenix Resources back onto my buy list, potential buy list. So I'm not going to go out and buy it, just a potential buy list. Resmed. Okay, Resmed. 6:07 p.m. Yeah. Resmed, this is the weekly chart. One of the reasons I think there is a concerted short attack against this company is just every single week the share price falls. Massive volume coming in as well. And eventually you're going to see value investors go, well, there's value here. P/E ratio 24, which is really low for this company, I would assume. That's lower than usual. Dividend yield 4.05% for a company that's growing. Had nice growth in the last year. So revenue up from 5 billion to 6.3 billion. Profit from 1.1 billion to 1.33 billion. Profit margin down a touch. But I think it's just around those diet drugs. So there's portions of the market that are concerned about that. And more than likely, those diet drugs are not going to be that successful. And even then, there's a lot of non-obese people who still get sleep apnea and still need Resmed devices. So this could be an opportunity where the market is completely overreacting. And so even though I do own Resmed shares, trading and a longer term position, I will definitely think about adding to my position if the share price keeps on falling. Not only that, if we look at the bottom of Resmed's share price during the COVID-19 financial panic, $19, I would become really interested in adding to my position if the share price gets to about $19. And if you have a look at the long-term chart for this company, it's been an uptrend ever since 2012, the weekly chart. So this is the first time the share price has moved into a weekly downtrend since 2012. And again, I think the market is overreacting. Why do I think the market's overreacting? Have a look at, it happens a lot. Maybe not a lot. So let's have a look at Cochlear. And I still remember this, 2012. It was one of these big dips in share price. So share price went from $87 down to $45 because there's some sort of recall in their Cochlear device. So there's a lot of people thinking that's the end of Cochlear, that stupid sort of mentality. And the market absolutely hates risks. So they thought this was a risk and added risk to Cochlear. And so the share price got down to a low of about $45. Share price now for Cochlear is $256. That was a beautiful buying opportunity for Cochlear. I wish that was 2011. I really wish I took a position in Cochlear back then. I didn't know the company all that well. Nice chart for Cochlear, by the way. Anyway, so Resmed is looking really interesting just because of this significant decrease in share price because of the fear of diet drugs, which, again, I think is overstated fear by the market. Another company which looks interesting based off where their share price is falling towards is Ansell. So this is the weekly chart for Ansell going all the way back to 2016. And $21 has been a really good buying price for Ansell. We have seen the share price hit that level 1, 2, 3, 4, 5 times in the past. And every single time, that was a really good time to take a position, including COVID-19 financial panic, including June 2022, December 2018, and August 2017. Share price now $22.50. So share price is falling towards that $21. The daily chart looks pretty bad though, just like it did back in June last year. You can see the share price dropped heaps over a few weeks and then rallied nice. V-shaped recovery in the share price. I don't think that's going to happen again, because one of the reasons why the share price is in a downtrend right now is because of bad financial report from the company. Price earnings ratio 12.97, dividend yield 3.1%. Revenue has dropped 3 years in a row for this company. Now they make rubber gloves and that sort of thing, so it's understandable to see a drop in revenue for this company. But more than likely, this company will go back to a growth phase in the next few years. And again, I think possibly the market is overreacting when it comes to Ansell. Sigma Healthcare, a company I was thinking of buying into after they released that deal with Chemist Warehouse on the 6th of June. Share price rallied to 88 cents. And it looked like the share price was remaining above 75 cents, a nice little support level for the company, but it's fallen through that. Share price now 71 cents. And one of the reasons why the share price has sold off last few days or last few weeks is because the company released their results and was pretty negative. In fact, that's not the reason why people are buying here. It's just that deal with Chemist Warehouse. So I'm very happy I did not take a position in this company above 75 cents, because now it's 71 cents. Avita Medical. Is this a buy the dip opportunity for Avita Medical? So this is the daily chart. Share price has moved into a beautiful uptrend. I just wish I bought this company back in January this year when it broke out at about $2.40. Share price actually went from $2.40 to a high of $6.20. Now the share price is $4.34, and the share price has moved into the long-term uptrend moving average ribbon. The last time it did this, back in May, that was the time to take a position in this company, a trading position. So will it bounce again, just like we saw in May? Remains to be seen. Who knows? I have no idea. But possible, nice buy the dip opportunity for Avita Medical. I do like the potential of this company for the future. There is nice growth. And management also talked about, they were fairly bullish about the next year or so. And I think that's one of the reasons why the share price ran up back in February, was based off their financial results and the bullishness from management. EBO, so we talked about Sigma 2 companies ago. I should have lumped these two companies together. So Sigma had that deal with Chemist Warehouse, and the company that lost that deal with Chemist Warehouse was EBOS Group. That's why the share price fell on the 6th of June, fell 12.3%. The reason I've featured this company, I'll actually be doing a financial 23 result video on this company. It was a viewer suggested. So again, if you look at a price of $32, you can see the share price has just remained above that level ever since that negative announcement. It fell through very briefly back in August. This looks fairly bearish. I actually would expect the share price of this company to drop below this support level, and then it becomes resistance. So it looks fairly bearish right now for EBOS Group, but maybe this is the low point for the company. And again, the reason I'm pointing this company out is because the share price, $31.98, is right on that support level. So if you like this company, maybe now is the time to take a position in this company or add to your position. Potentially, it's up to you. Oh, 3 companies to go. Third last is Red 5. So I went through all the gold companies, and this looked pretty good. So when I say it looks pretty good, let's have a look at some of the other gold companies. So which one? Let's have a look at Northern Star. Northern Star is looking bearish. Perseus, looking bearish. I think Ramelius is another one, looks pretty good. Yeah, it looks pretty good, although it's right at a nice little resistance level. Regis looks bearish. Resolute looks bearish. Go on and on and on and on. Capricorn is going sideways, just going sideways, no trend in the share price for that company. But Red, gotta find my watch list. Red looks actually pretty good. I don't know anything about Red 5. Market cap is almost $1 billion. No profit. Revenue 422 million. Loss making of 8.73 million. Revenue massively increased from last year, which was 163 million. So something's going right for this company just based off this chart. In fact, it looks fairly bullish right now. Share price actually did jump 20.5% on Monday, the 18th of September. I'm going to have to do a little bit of research on this company. Why does it look so good? I'm going to write it down. Red 5. Do a little bit more research on this company. Coles. So we went from a nice looking chart to an ugly looking chart, mostly. Okay, so it does look, if we turn attention to the weekly chart and then sort of expand. So Coles has been trading in a channel or a range, trading range, since 2020. So when the share price gets to about $19, you sell. Whenever the share price gets to, say, below $16, you buy. This has happened time and time again over the past 3 years. In fact, top of range, it's gone to that point around $19 1, 2, 3, 4, 5, 6 times. Not on some of these occasions, not quite to $19. To the bottom of the range, 1, 2, 3, 4 times. And right now, the share price of Coles is at $15.65, right at the bottom of the range. So if you like this company, maybe now is the time to buy. Maybe a trading position. And then sell when it gets to $19. Now, if you look at the revenue, flat. Relatively flat, we'll say. Profit, relatively flat. Now, realistically, Coles Group revenue should increase at the same rate as population growth. I give or take a little bit, because they might take a little bit of market share from Woolworths, or maybe they'll lose a little bit of market share from Woolworths, that sort of thing. But overall, Coles Group revenue should increase the same rate as population growth. And unless they can increase their margins, profit should increase the same rate as population growth. So we're talking about maybe 1 or 2% per year at the most. So you're really relying on the dividend, and the dividend yield for this company is only 4.22%. I would like a significantly higher dividend yield, because you can put the money in a bond or a savings account or a term deposit and get the same sort of return as 4.22%. In fact, you probably could get higher. So I'm not really interested in supermarkets right now, Coles or Woolworths. I do think they're overvalued. And Coles' PE ratio is still quite high at 18.7%, 18.7%. And that is, when you see a PE ratio of 18.7, you do or should expect growth. Much higher growth than Coles Group will show over the next few years. And lastly, A2 Milk. Now, I completely sold out of A2 Milk a few weeks ago. So, of course, I'm interested to see what the share price does after I sell it. Did I make a mistake? That sort of thing. At this point in time, the share price is lower than when I sold. So at this point in time, not a mistake. And the share price is in a really, well, maybe I'm being a little bit biased here. The share price is in a downtrend, a well-defined downtrend. And one of the reasons I sold of A2 Milk is simply because I don't like the management's obsession with China. China is experiencing some problems now, and those problems could persist. And I just wanted A2 Milk management to try other areas. They got out of the UK, if I remember correctly, but they're just too obsessed with China. I sort of like the Treasury wine management diversification strategy, becoming less reliant on China. In fact, I think Australia should become less reliant on China, because we have always been bailed out by China, which is why we didn't have a recession for 30 years or so, because China kept bailing us out. But China is having significant problems right now, and those problems could really affect this country. So we need to be less reliant as a country on China. A2 Milk needs to be less reliant on China to be successful. And they even mention in the financial results that China and lack of population growth there, people just aren't having babies, that, they're going to struggle over the next year or so. So A2 Milk, downtrend. At this point in time, not a mistake. But I'm going to keep watching A2 Milk's share price. And if I see a turnaround, maybe I'll buy some shares again in A2 Milk. So that's all I have for this video. that's enough for this video. So 20 minutes longer than I wanted it to be, but it's okay. So if you have any questions, any thoughts about any companies I've mentioned in today's video, just leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.